I'm here today with Julian Fosh, co-manager of the Liontrust Special Situations. This fund sits on Chelsea's core buy list. It has just gone through its 10th anniversary and has had very strong outperformance of the index. Julian, the fund's been going for 10 years with excellent performance. Can you highlight some of the things that you do differently than other fund managers?
We've got a genuinely unique investment process. We're drawing on 50 years of research at universities and business schools around the world into the importance of intangible assets in explaining competitive advantage. So in our three-stage process, stage one is to say, can we identify that a business has a genuine strength in one of three areas, either IP, intellectual property, or strong distribution, or high levels of recurring revenue. If it does, we then go into stage two, which is to say, in theory, that should allow it to earn excess returns as a business. We measure those returns often over 20 years or more to ensure, firstly, that it can cover its cost of capital, the basic task of any business, and then secondly, to ensure that it can earn a return higher than the market as a whole. And then lastly, we look at valuation, deliberately lastly, and we seek to buy it at a price where there's some upside left for us.
You've been running the fund for 10 years. You must have seen a lot of change in the world and how information flows. Give us an outline of some of the things that you've seen change.
Well, I suppose the increase in the pace of technology has been remarkable. Globalization, has led to, particularly for businesses, enhanced levels of competition. And in our world, in the stock market, obviously people seem to have become more and more short term. And I think in that environment, it's really important to emphasise, or we would emphasise, the advantages of a long-term thinking and a long-term process. So we're seeing select a portfolio between 40 and 60 companies, value-creating companies, which we can buy and hold on to for the long term and let really them do the work and deliver the value for us and for your clients. A low-turnover approach and long-term thinking.
And lastly, outlook for 2016 with focus just wholly on UK equities.
Sure.
Are there pockets of value, or where do you see some opportunities within your type of stock?
Sure. It's I think for the average company, it's a difficult environment. Growth forecasts are scaling back. You can see in the returns from the UK market, return on capital is actually falling, even though we're 2 years into economic recovery. We've had, as you pointed out, a great year this year, and there are plenty of companies that are trading very strongly. Some have been left behind. So big oil, for example, the oil price fall has led to, we'd say, to an overreaction in share prices. Some of the engineers and industrial companies also offer good value, and there are always exciting small companies which are defying trends in their markets.
And that again has always been a strong part of Special Situations, is a meaningful portion of the fund in small companies.
Absolutely, 26% at the moment. It'll never go below 20% because there's an acknowledged small company effect in the market. Small companies definitely add value over the long run.
Julian, thanks very much.
It's a pleasure.